Welcome back. It's time now for top picks from our guest, Brett Gerard. Let's go to number one, Brookfield Corporation, ticker symbol BN on the TSX.
So Brookfield, and they'll tell you this, they own assets that are the backbone of the global economy. So that helps when we go through volatile macroeconomic events. Their assets will always be in demand, whether it's toll roads, whether it's bridges, whether it's ports. They're going to continue to do well. The stock's up over the last year. It's actually done reasonably well, in spite of what's been a challenging private equity fundraising environment. To their credit, they've raised about $143 billion over the last year that they'll deploy over various funds. And when they deploy that and then make the sales down the road for likely higher valuations, they will generate carry. And the carry is return on investment that goes back to Brookfield and back to us as investors. So there's a strong and long pipeline of carry coming. And I think it's a great name to consider adding to the portfolio. You will see some lumpiness because carry is not always consistent. But in spite of all that, the dividend increased by 8% in February. Over the last 10 years, it's grown by about 14% per year. So if you're thinking about having a stock that's going to help you in retirement, you want to have that high dividend growth that'll offset inflation, and it will create cash flow that you can draw down once you stop working and you need to pull from your portfolio.
Okay. Now, one viewer we're keeping in mind here is Brian, who asked a question about his son's TFSA. He already, in our understanding, owns this one. So this is not the one that would fit, and neither is the next one, because Brett advised us that in TFSAs, you are better off not including U.S. dividend payers, because those dividends will be taxed in a TFSA. But his next top pick, nonetheless, is Nextera, ticker symbol NEE in New York. Brett?
So Nextera is the largest electric utility in the U.S. If anyone's been down to Florida, they're familiar with Florida Power and Light. That's a big component of Nextera. That's really the cash cow that they've effectively have a monopoly on the state, and they generate power for the growing population of Florida. With some of the proceeds from that, and again, this is why we want to see free cash, they've reinvested significantly in renewable energy. So we're talking a lot about AI. As it turns out, AI needs a ton of power. If you look, and there's been some estimates that are out there quite interesting, one chat GPT search requires 10 times the amount of energy as a Google search. So if we're going to be moving into this AI world, we're going to need energy. We're going to have to figure out a way to power the grid. And it's going to be on the backs of renewables. It's going to be on the backs of solar and wind, and really plays well into what Nextera's assets are going forward. Okay,
Nextera, number two. Okay, here's the one, Brian, that I think Brett is going to say might be suitable to your son's TFSA, Alimentation Couche-Tard, the Montreal-based convenience store, gasoline store giant.
So sometimes we have these gems sitting right in our backyard or at our corner that we drive by every day, and we don't really recognize the importance or the scale of some of these companies. They have 17,000 locations worldwide. They just completed an acquisition that gives them a good presence in Germany, in Belgium, in Luxembourg, and it's really a name that I think people around the world are starting to wake up to. If you look at 7-Eleven, their largest competitor, they have about 80,000 locations, so they're about 5 times as large. But Couche-Tard has a ton of room to grow. If you look at their addressable market, they have about 5% of the convenience stores in the world. 60% of the convenience stores in the world are owned by single-family operators. So there's a huge runway for acquisition over time, and they've done a very good job staying disciplined through 2020, 2021, not buying when private equity was in, when prices were high, and now starting to make the meaningful acquisitions that are going to be accretive to their bottom line.
Company has always, almost always succeeded with acquisitions and has been a disciplined acquirer. It's walked away from a couple over the years when the price got too high. You think this will continue into the future, successful acquisitions?
Absolutely, yeah. And I think if you look at the business, they're starting to really think about loyalty, which is important. So they're adding on the car washes, they're adding on the quick service restaurants. And even if we do get into a position where we start to have more electrical vehicle penetration, people aren't necessarily pumping gas. The half of their business is coming from non-gas entities.
And you see this stock being a dividend grower as well, correct?
Dividends grown significantly over time. Yeah, so if you look, 29% in the last year, 23% per average over the last 10 years.
First top idea, Crescent Point Energy. The Crescent Point of today is not the Crescent Point of old. And I think I've been doing this show, I think 13, 14 years. It's very different back then. It used to be a company with a lot of low-rate wells, southeast Saskatchewan, a CEO that was extremely acquisitive and such, constant ranks, all these different things. The Crescent Point of today, and they have a new name coming, and you can chuckle about it, but it's a very different company that I just don't people fully appreciate the transformation. You now have a company that has significant drilling inventory in both the Montney and the Duvernay, a company that has proven themselves to be able to drill much more complicated and expensive wells, and they've now drilled some of the most economic wells ever drilled in the Montney. You have a board that's very conservative. I've presented to them in the past, very well respected by myself and the street. A CEO is a very, very steady hand. I'm not going to wake up to some crazy press release. And someone who has pledged that they are done M&A for at least the next year to 2 years. So they have more than adequate inventory. When I look at it at $4 NYMEX next year and $80 oil, we've got them trading at 3.5 times cash flow, a 17, almost 18% free cash flow yield. We are now getting 60% of that free cash flow. The remaining 40 is going to the bank to delever from the acquisition or debt that they took on from acquisitions.
Hammerhead, notably,
yeah.
I guess. Yeah.
So as they bring down debt, we expect that 60% to go to 80% in a year-ish time. So in the meantime, they're buying back 10% of their stock. They continue to drill incredibly profitable wells. They have 15 to 20 plus years of stay flat inventory. We think this will re-rate to, again, a 10% free cash flow yield. That's true of the entire sector. In our mind, that's almost a $20 stock, so 62-ish% upside. In a name where I think about, other than commodity risk, I don't have M&A risk. I don't have, management. I can very sleep at night, and I'm a significant shareholder both in my fund and personally as well. It's got all the attributes that I look for in a name.
So they did that acquisition of Hammerhead Energy last year. It was worth more than $2 billion. Did people have misgivings about it at first?
I think there was a perception that they've paid fair value for that, but you get what you pay for in a sense, in that things are always competitive. They thought that timing they were going to have, because they did it before year end last year, they had an advantage of scooping it and not having to pay as much were it to go much more competitive, because there were some companies that would have been natural acquirers that for idiosyncratic reasons could not bid on it at that time. And so I think they came to Hammerhead with a very fair price, but they saw the value in the asset, and the drilling results have corroborated that. They're drilling just boomer wells.
And it makes them huge in the Alberta Montney, obviously.
Very significant.
Yeah. Paramount Resources, a natural gas name.
This is my first natural gas recommendation in as long as I can possibly remember. And so we have a full position now, so I'm happy to talk about it. It's a 5% weight in our fund. I intended this at least to be a long-term strategic holding for us. The reason why we own it is that at $4 gas next year, so that's slightly above strip. Strip next year is about $3.50. At $4, this is the least expensive stock in North America that we can find, where it has adequate market cap to be relevant to more than just a handful of people. What I like is the CEO and the rest of his family, Riddell's, own about 45% of the company. He's very methodical. He's very thoughtful in terms of M&A. When you account for strategic investments that they hold, they are the largest shareholder of NuVista. They have other assets. When we strip that out, the company is debt-free. And so my hope has been for the past year that they would be able to do a counter-cyclical acquisition in gas. Maybe they can, maybe they can't, because I think the bid-ask, as everybody buys the 2025 LNG dream, is still fairly wide. So on their own merits, we see it as very compelling. Growing production, this is not a buyback story, but growing production by about 10% per year each year for the next 2 years, remaining free cash flow, I think, eventually to be returned. I get about a 4% dividend in the meantime. And we think a fair multiple is about 5. That gets us about 72% upside from here. And this is not a name on the radar screen of everybody. This is not a name where every generalist owns. And so as I think people get more incrementally bullish on natural gas, they're going to look to see, okay, which names have lagged, which names the risk reward is very compelling in our favor. So I think about strong inside ownership. I think about a strong technical team that's very good at finding acreage before others and proving up the value. I think about a name trading, again, 2.7 times cash flow. That's offering us that risk reward ratio is very much in our favor.
Finally, precision drilling.
That's right. So I was asked before about services and Trican and all these different things. I like drilling over pumping. There are far fewer competitors. Historically, pricing is much more disciplined. We've seen companies within the drilling space talk to how pricing's been generally firm, maybe moderately down, but not nearly as much as pumping in the face of extraordinarily weak natural gas pricing. The Canadian market is much stronger than the US, and so there's evidence of US investors coming to look to Canada. And from a market cap perspective, from a trading liquidity perspective, there are very few service names that you can own. And so we look at precision drilling. 2024 is kind of base activity. We've had the rig count not go up that much. Gas is flat. Activity is going to be challenged. That is well known. So even being conservative in terms of activity expectations, pricing expectations, the stock's trading at a 26% free cash flow yield. And I think about a company, when you're a driller, it's steel. You don't have an inventory which you're depleting and decline rate and all these challenges. With maintenance capital, these rigs last 20 years, but they could privatize in 4. So I'm getting many years of this asset, I think, for free. Importantly, if you get a little more optimistic on pricing next year, very, very conservative, we think, the stock's trading at a 31% free cash flow yield next year. They've committed to return 30 to 40% of that free cash flow. We've presented to their board once. We own 9.9% of the company. We think ultimately we should get 50% once they hit their final debt targets. We think they're being a little conservative debt, but we understand from the historical challenges that the entire space had with too much leverage. So we see a name where they've massively paid down debt. We can get very excited using this year's assumptions, which we think are conservative, get a little bit more optimistic on gas activity, LNG, all these different themes. We think at a 14% free cash flow yield next year, that's a $218 share price, that's 137% upside. So to us, that's very compelling.
First idea, Astera Labs. Now, this may have been the one that the caller referred to at the beginning of the show, thanking you for referring us to it. What are they all about? Why do you like it?
Well, they just did an IPO back beginning of March, I think it was.
Okay.
So it was priced at 32. It opened at 58, and it shot all the way up into the 80s. But with the retreat of the market last week, it actually got down into the low 60s, and it was a bargain down there. Still at this level, we still think it's a bargain. So what do they do? And actually, all 3 companies that I'll talk about are all about communication as a service or infrastructure as a service. So you've already got like the infrastructure and the hyperscalers in the cloud companies, right? And now you have all of these software companies that are coming out with certain different ways of processing the data. But what Astera does is that it allows the different software companies to actually connect their solutions very quickly with the cloud and with other software and with other networks out there. So it's a very data-centric company. And so it's an Israeli company. We have one of our analysts is in Israel. He knows these guys inside out personally too. So it's all about high-speed connectivity, leveraging all kinds of technologies within the cloud. So we really, really like this company. Currently trading at $70. We have a 12-month price target of $86, but you can be sure that that is going to be raised as it sort of gets toward 86. It flies under the radar. I would recommend that you invest in it. Put in, I don't know, somewhere around 3, 4, 5% of your portfolio on something like this. And I think you'll be very, very well rewarded.
Your next idea is Marvell Technology.
Yeah. So Marvell, again, still in the semiconductor side. But remember when, and you've seen it, Andy, around the city where they were digging up the roads and they were replacing copper wires with the optical wires, right? And so Marvell actually got on top of this, and they brought semiconductor solutions that were very, very much geared toward the optical cables. Now, a lot of other people, but they were the first one on it. The other thing that Marvell is very well known for is the system-on-a-chip architecture, which is geared toward edge computing. So you have the data center over here, and then the data center sends out the signals into the various devices, the phones and the laptops and so on, out in the periphery. But what Marvell does is that they actually have these system on a chip that actually go right out to the edge. So they actually have the processing power right on the edge in the devices. So that's sort of the layman's version, but it's it's a leading designer. It's been around for a long time. Developer, supplier to integrated for high-speed communication, i.e., the optical side. So currently trading, I think, around $64. We have a 12-month price target of $75.
And then your final idea, Broadcom.
Yep. We're sort of going from very small to large. Broadcom, the symbol ABGO is because of the company that they bought back in the late teens, 2018, 2019. They're a massive company, almost 600 billion market cap company, currently trading at 1,250. Yeah, and we have a 12-month price target of $1,573. Now, 3/4 of the revenue come from semiconductors, and a quarter of it comes from infrastructure software. On top of that, they actually have a 3% dividend. They've been around this was an offshoot, if you go all the way back to the 60s, from Bell. And so...
Ma Bell in the States.
Yeah, Ma Bell, yeah. So it's involved in everything from system on a chip to cable, digital line, optical, Ethernet switching, routers, and so on. So they're as you can see on the semiconductor side, they're very, very much on the hardware side. So I'll leave it there. But for those that I'm sorry I didn't get to answer your questions, please just give us a call at Black Swan Dexteritas.
Time now for top picks with our guest Robert Gill. Top pick number 1 on this day, a very familiar name, Canadian Tire, ticker symbol CTC.A on the Toronto Stock Exchange. Robert?
Thanks, Paul. Yeah, well, it's often been said that hope, fear, and greed drive the markets. So to make money, you need to be contrarian, and you also need to go where others do not want to go. This is how you make outsized returns, and currently, Canadian Tire is a contrarian idea. It's a business that a lot of us are familiar with, though. It's a known brand with plenty of history. The company is a retailer of tools, automotive, seasonal items, appliances, and clothing, and it always seems to be in the mix when you have a project to do. It often has the solution that you want. So the company is a competitor to Home Depot, Home Hardware, the dollar stores, and Walmart as well. It's assembled a nice portfolio of brands over time that includes Sport Chek, Mark's Work Warehouse, Paderno, and Helly Hansen, and they've done a very good job of steering their business away from online retailers such as Amazon. They've done that by addressing such markets as automotive, garden furniture, and sports equipment. So it's very difficult to put these items in the post and send them from A to B. Now, shares are down from an all-time high of $215. If we take a look at the share price chart, and they're about $134 now, and this is due to concerns of recession and shifting out of equities and into bonds. But if shares rebound from here, again, it's a reversion to the mean play, then that's a 60% return, and that's without the very impressive dividend as well. The market's concerned that we could enter a recession or that consumers are highly levered and they may stop spending. But let's be absolutely clear that while Canadian Tire does face some of these issues, other retailers also face these issues. So these are not issues specific to Canadian Tire. They're specific to, or they're general to the overall industry. At the end of the day, the company has very good profitability, has a strong balance sheet, trades at 12 times earnings, and it offers a 5% dividend yield. So there's a lot here that we see when you put it all together. We think that it's a good buy right now.
Okay, here's another one that may fit in that contrarian camp. Robert will clarify that with us or not. And we were at the top of the program. We talked about the fact that he saw opportunity in telco stocks. Well, here is one where he sees opportunity, BCE, ticker symbol BCE on the Toronto Stock Exchange, trading at its lowest share price in many, many years and yielding something close to 9%. And of course, this company is the parent of this television channel through its Bell Media division. Robert, why do you like BCE?
Thank you, Paul. I feel like this is a kind of deja vu. It's the second time I'm getting this question from you today. But you're very on point for sure, and we are sticking with a contrarian theme. BCE is a contrarian pick right now, but there is a place for it in a diversified equity portfolio. BCE is a large blue chip company with a strong brand. The company is a household name providing cable, internet, wireless, and wireline phone communication. It also owns Bell Media, which is Canada's leading content creation company with assets in TV, radio, and advertising. The company is considered to be a conservative investment given its long history, its conservative stewardship, and its long life, high quality assets. Now, shares have traded down for three reasons. First of all, this is an interest rate sensitive stock, so higher rates have pressured the share price. It has a very impressive dividend yield that you mentioned, close to 9%, and that has to compete with higher bond returns now. But investors are concerned about the erosion of share prices, and therefore they're shifting money out of higher yielding equities and into fixed income for the better perceived risk-adjusted return. Secondly, competition. So there's plenty of competition right now. This really picked up after the Shaw acquisition by Rogers, and Rogers then sold Freedom to Quebecor, and Freedom engaged in a bit of a price war. So that has created competition more so than usual. Lastly, in terms of the regulatory environment, that's being challenging. The government of Canada is asking BCE to share its network with a number of other operators, and this is despite the fact that BCE has had to bear the brunt of the cost of that network. At the end of the day, regardless of these issues, the company trades at a very attractive multiple. It's at a 10-year low, has a 9% yield. The multiple's cheaper than the stock market. It's a higher quality company than the market. We like it as a buy here. Okay, we've got about a minute and a half or so for our final top pick. That's Alimentation Couche-Tard, the gas station convenience store giant, which has been a acquirer of those type of assets in the U.S., in Canada, and in Northern Europe as well, and elsewhere around the world. Yeah, very international company for sure. It's one that we've owned for our clients at Goodread for some time, and I'm happy to say it's done well for us. It's a long-term holding in many Canadian investment portfolios. It's a global leader in the gas station and convenience sector space. Geographically, it's very well diversified with stores in Canada, U.S., Europe, and Asia. It boasts over 17,000 stores in 24 countries. It also has the brands Couche-Tard, Ingo, and Circle K, which is its predominant brand in the United States. Most of their revenue comes from road transportation fuel, but they also sell coffee, snacks, beverages, lottery tickets, and merchandise. In terms of its growth, the company takes their growth very seriously. They are serious acquirers in terms of M&A. Their most recent large deal was last year. They bought 2,200 gas stations from Total Energies in France. We like the company, has strong fundamentals, good profitability. It trades at an attractive multiple, and we suggest that individuals should buy it now. Welcome back. Time now for Mike Philbrick's top picks. Top pick on this day, for our first top pick, is the BMO Equal Weight Oil and Gas Index ETF, ticker symbol ZEO, on the Toronto Stock Exchange. Mike?
Yeah, so we talked a little bit earlier in the call today about XEG, I think was, and we talked about the concentration in the top two names. So with the BMO Equal Weight Oil and Gas ETF, what you get is an equal weighting across the sector. So you're getting much more exposure to breadth, not just CNQ and Suncor. Currently, the yield is 4.2%-ish, so it's got a nice yield. MER is 0.61, so great. And from the standpoint of where we are in the sort of energy cycle, I want to go back in time and think through. In 2008, if we look at the U.S. experience, so I want to look at the S&P 500 and think through that. In 2008, the S&P Energy Index composed 16% of the S&P 500. In 2020, it consumed 2%. All right. Today, the S&P energy sector within the S&P 500 is about 4%. If we go back in time, the bottom was 1999 at 5%, 1991 at 16%. Why am I talking about this stuff? Well, Microsoft has a market capitalization of 3.1 trillion and annual cash flow of 67 billion. The S&P energy sector is 1.6 trillion in market cap, half the size, and has double, about $135 billion in cash flow. So from a valuation perspective, you're getting a much, much bigger bang for the buck in just thinking through making sure you have some energy exposure in your portfolio. Secondly, how much does energy impact our lives every day? You heat your home, you fill your car with gas, you cool your home in the summertime. This is a large impact. Now, Canadians are lucky in that 20% of our TSX index is kind of energy related, but I think Canadians have probably to some degree gotten carried away on the tech side of things too with a lot of US energy exposure. And I just want us to be careful. Remember at the outset, we talked about the recessions, the inverted yield curve, the potential for oil shocks to have that impact in accentuating that. So let's make sure we have something in our portfolio that can benefit in a period like that.
Okay, let's go to number two. We talked about silver in this program as well.
Yep.
Number two is the iShares Silver Trust ETF SLV on the New York Stock Exchange ARCA Index.
Yep, and again, critically underexposed materials are only 2% weight in the S&P 500, the largest and most followed index in the world. You've got industrial demand for green technologies, as the caller talked about. You've got the inflation hedge that comes with the precious metals and silver and the precious metals. With economic uncertainty, silver can actually act as a little bit more leverage play than gold, so you don't have to own as much of it to get that same sort of participation. And then we talked about the geopolitical circumstances as well, which kind of lend to precious metals being something that you want in your portfolio, both gold and silver.
Okay, and number three is also commodity related, the Sprott Physical Uranium Trust, ticker symbol U.UN on the TSX, not an ETF, correct?
Correct. This is a slightly different. It's an exchange traded product, but it is not an exchange traded fund. And all that means is that there's not that fungibility, so it can trade away from the NAV a little bit. So if you can pick this up when it's trading at a discount to its NAV, that is a wonderful thing. It's the world's largest physical uranium investment fund, and it's a convenient way to own, what is a pretty interesting asset to own. We've talked about AI, we've talked about semiconductors. Those are going to demand a lot of energy. That energy is going to come from, some of it's going to come from hydrocarbons. The next place it has to come from is probably nuclear energy. And when we have the decarbonization goals that we have, as well as energy security, we just saw the US say that we're going to start enriching uranium in the US again. Because where does enriched uranium come from? It comes from Russia. And our relationship with Russia is not that great. So you've got security concerns, you've got decarbonization concerns, and then you've also got the technical advancements that have happened in the reactors. So you've got modular reactors, smaller reactors. Canada has some of the leading technology in the world to provide this type of energy. So I think that this is again a large, long secular trend that has a lot of legs to it. So this is something that's recurring. The last time I was on, I recommended AERA, which has the underlying commodity as well as the stocks. So I think that this is a continuation of that.